Hello, good afternoon. Give another minute or two for some other people to hop on here. We're going to talk about charitable gifting today. We're coming up on the end of the year, so I think some people might be looking for ways to save some money on some taxes. And obviously, making charitable contributions is one way to do that. But give it another minute or two for people to hop on. See our numbers coming up here. All right, we're about a minute past. We'll go ahead and get started. I am Nate Zeller. I'm the Chief Investment Strategist here at Secured Retirement. Thank you for joining us today. We are going to discuss charitable gifting. Like I just mentioned a second ago, this is a somewhat timely topic given that we're right at the end of the year, and oftentimes people are looking for ways to take some extra tax deductions. So this is one way to go about doing it, and I think gifting is maybe on a lot of people's minds as we enter the holiday season here. So we'll get right into it. Thank you for joining us today. Do have to give our disclosures. Information, opinions are subject to change without notice. We are going to be talking about some tax topics today, but it's not meant to be individual tax advice. Obviously, for tax advice, seek your tax advisor. So what I'm giving here is just general advice, not meant to be individual. So getting into it, when you pass away and your time on this planet's over, there's really three places where your money will go. Maybe you decide to spend it your entire life and there's nothing left, but we're going to assume here for a second that there is money left. It can either go to your family or maybe even friends. Doesn't have to be restricted to family. It can be anybody that you know. Uncle Sam, as far as taxes, we'll take a chunk unless you do some planning, or it can also go to charity. And there's obviously advantages to donating to charity. Obviously, it's something that's a very personal decision that you make if you want to take that road, but there are reasons for doing so. Obviously, monetary and non-monetary. I think all of us can pretty much agree that having our money go to Uncle Sam's the least desirable outcome of these three scenarios here. So looking back at the Tax Cuts and Jobs Act of 2017, or what they called the Trump tax cuts, that's why we have a picture of former President Trump here. What this did is it changed the amount of the standard deduction. Previous to this, the standard deduction was much lower, and so it was easier for people to itemize deductions on their taxes. What happened with this act is it brought up, actually, we're going to go to our standard deductions. It increased the standard deductions to $12,950 for 2022. It was lower back then and it's indexed for inflation, but this year it's $12,950 for a single or $25,900 for a married couple. And that's a rather high bar to reach. So a lot more people now just take the standard deduction and they no longer itemize, where maybe historically in the past they did itemize. If you itemize your deductions, what you have to do is obviously cross one of these thresholds, which really isn't too far out of the realm of reason for many people. Some of these deductions may include unreimbursed medical expenses over 7.5% of your adjusted gross income. If you have mortgage interest, where mortgage rates are today, now if you locked in your mortgage, we'll call it more than a year ago, pretty likely you probably don't fall into this category, but if you do have a mortgage that you've picked up in the last few months when mortgage rates are a lot higher, there's a lot more people that are paying more mortgage interest and crossing these thresholds that I mentioned previously. Another deduction is the personal property, state, and local taxes, otherwise known as SALT, stands for state and local taxes. Prior to the Trump tax cuts, this was at a much higher cap. Now it's capped at $10,000. So it's somewhat limited for residents of Minnesota and Wisconsin as well, where we do have state income taxes and paying property taxes. A lot of people do hit that cap pretty easily, the $10,000. Another source of deductions are charitable contributions, which is what we're going to be talking about today. I did get my slides a little out of order, so the three strategies that we are going to discuss are gifting your gains, grouping your gifts, as well as gifting your IRA. So how do we do this? You can gift your gains. So one way to do it is just simply gift cash. If you see a charity or there's a charity that you are endeared to and would like to support them, you can provide a cash contribution. There's certainly no harm in that. Another way that people do it, and oftentimes this time of year too, is they gift stock, highly appreciated stock. It makes a lot of sense from an income tax perspective to gift the stock, so that way you avoid paying capital gains. We'll talk a little bit more about this here in a second. You can also contribute other tangible property. I know some charities take used cars, for example. Obviously, a lot take clothing, or they do coat drives. I think a lot of charities would accept most anything within reason. If you had highly appreciated art, for example, I'm sure that they would take that and sell it and do something with the money. Um, so let's talk about what the limits are, though, for this. So if you do contribute cash, you are limited to the deduction. The biggest deduction you can take is 60% of your adjusted gross income for a given year. If it's a non-cash asset such as stock, you're limited to 30% of your adjusted gross income. And then these can be carried forward for up to 5 years. So where this really comes into play, generally people aren't going to contribute more cash than what they have for income. I suppose if you're independently wealthy or an extremely wealthy family, that maybe that'd be the case. But I think in most cases, what we'd be looking at is non-cash assets or appreciated stock. I mean, if you take somebody that's maybe been working at a company for a very long time, we see a lot of that around here. Some of these larger Fortune 500 type companies whose stock is highly appreciated. And if you work there over 30 or 40 years, you might have a pretty good nest egg built up, but a lot of that might have a very low cost basis. Or maybe you're just a very astute investor. You bought companies like Amazon and Apple 20 some years ago. They've split a number of times, and that stock's worth a lot more than it is now. But getting back, let's say that you have an adjusted gross income of $100,000, but you have $1 million worth of stock to contribute. You can only take a 30% charitable deduction, 30% of your adjusted gross income. So you couldn't take the full $1 million, but you can carry that over for up to 5 years. What are some of the strategies to what we call gift your gains? And this would be the highly appreciated stock, is you can gift it directly to a charity. The way this would work is you would simply just give the stock to them. You can transfer it. In our case, we custody with TD Ameritrade. If you let us know which charity you'd like to gift it to, we'd contact them, understand how we could just send it directly to them, and then you could take the tax deduction for that. And then once it was there, the charity would sell it and you would not have to pay the capital gains tax. Another way to do it is what we call a donor advised fund. We'll talk about that here in a second. Or you could fund a charitable trust. A question did come in. How do we know if doing a charitable donation provides enough of a tax benefit or not? Do you have any math related to figuring out whether we should do it or shouldn't? We do. We're certainly glad to sit down with people and go through the math on that. I do have a very simple example here coming up. In a lot of cases, especially when we're looking at stock, we would have to put pencil to paper to see if it would be worthwhile for you to make that from a monetary perspective. But that is certainly something that comes into the equation, is figuring out exactly what that deduction would be and whether or not it makes sense. So a donor advised fund, the way these work is that you would contribute cash or property such as stock. A lot of times people do highly appreciated stock into the donor advised fund. You receive a tax deduction based upon that contribution, and then you would control where that money goes. And it doesn't have to go to charity right away. You contribute it into this fund and then it sits there. So you receive your tax deduction, and over time, I mean, the money remains invested. If it's highly appreciated stock, most likely you've sold that and diversified the investment. Then over time, you choose which charities to distribute the money to, and you could distribute it all in 1 year. You could distribute it down the road over a number of years. You could also make further contributions to the fund as time goes on, and that's oftentimes what people do, is they fund this year to year and then make distributions to charity as they see fit. Charitable remainder trusts. These get a little more complex, but this is a very good estate planning tool as well. So what you would do here is, if you had highly appreciated stock, and in this case, it's probably a rather large dollar amount, you would transfer it into a charitable remainder trust, and these are irrevocable trusts. So once you make the transfer, there's no turning back or coming back out of it. As the name says, it's a remainder trust. So during your lifetime, you receive a payment, and that's calculated using some IRS tables, and it's not a simple calculation, but certainly something that we would do. Calculate how much you'd receive during your lifetime, generally on an annual basis. A lot of times people break it up into monthly or quarterly payments. And then when you pass away, anything that's left goes to charity. If you do contribute highly appreciated stock into something like this, it does get sold. You do take the tax deduction initially, get sold, so you do not have to pay capital gains tax. With the thought being, again, you diversify it, you receive these payments during your life, and then anything there should be still substantial money there left to the charity upon your passing, and throughout your lifetime, you've received a pretty good income stream. This works extremely well for highly appreciated stock where maybe somebody doesn't want to sell it and have to subject themselves to capital gains. And when they sit down and do the math, they'd actually come out ahead by using a charitable remainder trust. As a bit of a side note here too, you might say, well, the family, if you have heirs that you'd like to receive some of the money, um, it it would all go to charity. Well, what you might do with some of these payments coming out is you could buy life insurance with it, and then your family would be in possibly a better spot too, and they really wouldn't be out anything or minimal amount. The flip side of this is what we call a charitable lead trust. And this works just the opposite. You transfer property, again, a lot of times it's highly appreciated stock, into a trust. The payments go out to charity first, and then what's left over does go out to your family. That amount of time that the payments go to charity is not based on your lifetime. It's based on a fixed set of time, what, 5 years, 10 years, whatever it might be. And then at the end, the remainder goes out to your family. Again, you'd take highly appreciated stock, you'd sell it, diversify it. Hopefully the amount would grow. The charity would receive a substantial amount of money, and then your family would still have something left over at the end. Couple of questions here. Do you see any potential changes in the tax code laws that might affect whether we'd want to do a charitable donation or not? Certainly. We just got through our midterm elections, so it will be interesting to see what happens in Congress the next couple of years if there are changes. I think the biggest potential one is the Trump tax cuts that we talked about previously with standard deduction. Those are go out at 2026. Beginning tax year 2026, we revert back to where we were before. So we would assume that the standard deduction would return to a lower place. There's a lot of time between now and then, so a lot of things could happen. I think the biggest factor here is probably going to be that standard deduction amount. I do not see Congress repealing the amount, of the charitable deductions that can be taken. That's certainly something kind of in public policy that it'd be a hard sell to say, hey, we're going to eliminate the deductions that people make to charities. It would most likely result in fewer contributions. So I don't see that going away, but certainly do see changes in the tax code and the standard deduction, which may or may not make it more sense for more people to contribute to charity. Then the question here is, the money transferred to a charitable trust considered taxable income? Actually, it's the opposite. Money transferred to a charitable trust is a tax deduction. Based on a number of factors in that amount. So you are not taxed on that. To get into the weeds a little bit further, when we look at our charitable remainder trust, as you receive this money, part of that may be taxable to you. There's gains in income. There's obviously investment strategies of getting around that. But when you make these contributions into a charitable trust, you receive the tax deduction up front right away. All right, another strategy, or the second one we're going to talk about today, is grouping gifts. You can do this either on a calendar basis or through the donor advised fund. Again, we'll get back to that. So this is what we call grouping. This is a calendar example. So what you might look at doing is, here we are at the end of the year, and you can make gifts for the tax year 2022. And then if you want to do this, say if you plan on contributing money in 2023, maybe you make that at the very end of 2022, so those gifts all come under the same tax year. Or conversely, maybe you wait until 2023 if you know that you're going to have a larger income next year, and it might make sense to make these contributions in the same tax year. Really, you could do 3 in the same year if if you're looking to afford a 2024. Maybe you make a contribution early in the year for 2022, make one mid-year for 2023, then one at the end of the year for 2024 if you're looking at contributing a set amount to a certain charity on a regular ongoing basis. And here's a quick example. So if you have your state and local tax capped at $10,000 you're taking, you contribute $10,000 to charity for 2022. That's a total of $20,000. Married couple filing jointly, that standard deduction is $25,900. So there wouldn't be any tax benefit to doing that. However, if you went out and on the very last day of this year, or you could do it a little bit sooner, and you're looking to make that charitable gift for 2023, and the way it actually works is the charity has to cash the check in the tax year. So you can write it on December 31st, send it to them in the mail, then they'll cash it in the tax year 2023. But you'd get the credit for 2022. So then your total would be $30,000, which is obviously more than the $25,900. It's like $4,100, and you would save some money there with the difference. So that's what grouping is. And well, what I was going to say too is that same thing works for a donor advised fund, like we were talking about earlier, where if you're making contributions to a donor advised fund and you plan on making certain contributions each and every year, if you want to make the 2022 and the 2023 here right at the end of the year, then go ahead and do it, and you can group them for this year and obviously get some tax benefit from that. Then the last one that we're going to discuss is the qualified charitable deduction, which is a gift from your IRA. And the way that these work is that the deduction from your IRA is paid directly to a charity. So you do not receive it. You don't want the distribution to come to you and then you pay the charity. It should come directly out of the IRA, directly to the charity. In order to take advantage of this, and you get a deduction on the full amount. This is not limited based on income like we were talking earlier. You do have to be at least age 70 and a half. So with the Secure Act, previously the required minimum distribution age was 70 and a half. So when you had to start taking money from IRA, with the Secure Act, that was increased to age 72. However, the qualified charitable deduction age was not increased at the same time. So you simply have to be 70 and a half. The amount that goes out does not have to be your required minimum distribution. If you are over age 72, this could help satisfy some or all of that. And you are limited to $100,000 per year. And the gift, like I said, does have to go directly to charity. So that's another strategy that we see a lot of people use, especially those people that are in the RMD stage, have to take money out and want to avoid taxes on it. That's really all that I have today for our charitable strategies. If there's any other questions, feel free to put them in the chat box. We'll be watching that here for the next couple minutes. We do have a few year-end reminders. Again, like we've been talking today, the charitable gifting, if you want it for the 2022 tax year, it needs to be done soon. We work obviously with a lot of other parties, primarily TD Ameritrade, for example, who we custody with. They do have some deadlines. So if somebody were to call us up at 4 o'clock on December 31st and expect something to get done, I'll be candid, it just isn't going to happen. So a lot of these things that we do want to get ahead of, be making plans for now, get it in process. I think we're looking at really about middle of the month, December, if not sooner, for most of these things. Another question came in: how do you distribute money out of a charitable trust? And so when you set up the charitable trust, you actually specify, and there's different types. They have a unit trust or an annuity trust. Annuity trust pays a set amount of money. A unit trust pays a set amount of money based upon a market value, and obviously will vary. The annuity amount would stay the same. When you establish the trust, you determine exactly what that would be. And again, there's some math that goes into this, IRS tables. It depends, on the life expectancy of the grantor, how much money, as well as the expected length of the trust. And so that's set up initially. And then, with a trust like that, like I said, it's irrevocable. So the trustee then would make sure that money does get distributed on a regular basis. And if it's a charitable remainder trust, would come out to you as the grantor, or if it's charitable lead trust, would make sure that money goes to the charities on the regular basis. For charitable lead trust, generally that's annually. Is this webinar recorded and replayable? Yes, it is. We are recording this. We will post it to our YouTube channel here in coming days. And of course, we're here to discuss any of this further too. If anybody wants to talk about their individual situation for their detail or get more info. Um, as far as if there's any other questions, please feel free to put them in the chat box. Other year-end reminders though, Roth conversions, for those of you that are looking to convert money from a traditional IRA into a Roth, which makes sense from a tax planning perspective. This year with the market being down too, it's a good time to take advantage of that. Get as much money as you can into the Roth in hopes that the market does rebound. We're cautiously optimistic that it will here in coming years. So get that money out, pay the taxes on it, and then watch it grow. And you aren't required to take it out, and you'll never have to pay taxes on it. So this is a good time to be doing that. Required minimum distributions, if you are over age 72, those do need to be taken by year end. We're working with individuals to make sure it's done, but if you have questions or need help with that, please don't hesitate to let us know. And then lastly, Medicare enrollment is the last day is December 7th, so that's coming up here in a couple of weeks. If you need help, we have partnered with Chapter Medicare. They are experts and they can help you shop plans and answer any questions you might have. Does it make sense to pay the taxes out of the same IRA from which the Roth conversion is made? It does. It really depends on your individual situation. The problem with paying taxes out of the IRA is that means it's more money that you have to take out to pay the taxes, and you can kind of see how that might snowball on itself. Ideally, you would have some money set aside and pay taxes on a conversion amount. The problem with that is not a lot of people have that kind of cash sitting around, so that's certainly something we can work with people on to determine which is the best way to go, and it really comes down to where that cash is available and whether it makes sense. Like I said, ideally we would pay it offside, but oftentimes people do pay it out of the IRA from which the Roth conversion is made. So that certainly is a possibility. Join us next week. Our market huddle will be on family gifting. Today we talked about charitable gifting. A lot of people, especially around the holidays, like to give money to family members. We'll talk about some of the ins and outs of that and what you need to be careful of, and ways to do it with avoiding any taxes or catching the eye of the IRS anyhow. And we would also like to wish everyone a very happy Thanksgiving. It's coming up this week, and enjoy the holiday. Enjoy spending time with family and friends. Our offices will be closed Thursday and Friday, but if you need anything in the meantime, please don't hesitate to contact us, and we'll be here. I don't see any other questions in the chat, so I think we'll end it for today. Thank you all for joining. Like I've said, we are here. If any of you do have questions, want to discuss further, please don't hesitate to let us know. Shoot us an email, give us a call. Again, my name is Nate Zeller. You can reach me here. I'm our investment strategist. I do a lot of our charitable work as well. So feel free to contact us if you want to talk about your individual situation. And otherwise, I'll let y'all go and get on with your day. Thank you for joining, and have a very happy Thanksgiving. Take care.